Hi, I'm Byron Moore, and this is Mike Jones with Argent Advisors. It's early February. If you look outside right now, it's 70 degrees with blue skies. And by the time you're watching it, it might be 20 degrees and gray skies. So if you don't like the weather in Louisiana, just wait a little while, it's going to change. And speaking of change, we have turned the calendar to New Year. We definitely want to get around to looking forward to what Mike and I expect for this new year. But we would be remiss if we didn't take a quick look backward and just ask the question, how did 2024 turn out?
Yeah, thanks, Byron. I would characterize 2024 as a good year, better than most. Yeah. Maybe not the most outstanding returns we've ever seen, but solid.
Not bad.
But not bad. But if you break it down and look at it closely, what you will find is that, well, I like to go to a source that we use, Morningstar.
Yeah.
They group together a lot of different asset allocation models that they track amongst financial professionals and do the grouping such as like aggressive, moderate, conservative, and so a couple numbers I'll throw out just to give context. The aggressive asset allocation grouping had in and around a 14% return for the year. That is better than, say, the long-term average of that.
14% is not bad in anybody's book.
The moderate was around 11%.
Still not bad.
Still not bad. The conservative was in and around the 5% range. And all that is very fascinating when you take into account a couple of things. First of all, yet another year where bond returns were not that great. The U.S. aggregate bond index was just north of a 1% return for the year.
Wow.
Okay. On the other end, the S&P 500 was around, with dividends, around 25% return for the year. Okay. Now, how could that be that you had a 25% return for the S&P 500, yet the aggressive group had around a 14%?
You were reading my mind.
Yeah.
That was my question.
And that is that, within the S&P 500, there were about 7 stocks, 7 big names. I won't list them all. We know them well. They had around a 48% return for
just
the year.
Those 7 stocks?
Just those 7.
Okay.
The other 493 had around a 10% return for the year. Okay. And so it all comes down to how you mixed and matched, how you blended things. But most people with a decent stock market allocation had a good year. I know what you think.
So I'm going to ask you the question.
I know what you're thinking. Yeah.
So, Mike, why don't we just go buy those 7 stocks?
Yeah.
So easy, right?
That's it. In hindsight, it's so easy.
It is.
But since we're using hindsight, let's go back to the year 2022, where those 7 as a group lost 40% for the year.
You're fired.
So yeah. so
we're not doing that.
You just have to manage the risk and get appropriate diversification and be satisfied with a solid return. Not chasing that phenomenal return because of what could come on the flip side.
Got it.
Yeah.
Okay, 2024, pretty good year. As we're looking ahead, what would we say? So I think you and I, as we were talking before this recording, we said, let's cover a few fronts. Let's cover the economy. Let's cover markets. Let's cover one real specific aspect of market influence, which is the Federal Reserve. And then let's talk politics for just a minute. So as far as the economy goes, there's no such thing as a all good or all bad economy. Economies have what we like to call headwinds and tailwinds. And so if you look at some of the headwinds that we see, some of the things that perhaps slow or impede the economy, you'd look at things like interest rates are a little higher than they used to be. We do have a kind of a tense political environment. Have we ever had anything different than that? And then also we got a labor market that might be a little off of its all-time high. So headwinds, yes. Are they major? Not really, especially not when compared to what we would see as tailwinds or kind of forces pushing the economy forward. And those would be things that we know well. For one, the consumer Consumer spending is worth 70% of the economy. Consumer spending remains strong. And so the consumer has proven to be, yet again, very durable and the source of U.S. economic strength. Second, the profits by American corporations, they are expected by all reports and all predictions to continue to really just surge, not just be okay, but to actually surge. They're really strong. And then we do have a little more perhaps business-friendly environment in Washington. So a little touch on politics there, which we will come back to. So that's the economy. Let's talk about what's within the economy that most affects portfolios, Mike, and that is the financial markets. Tell us a little bit about what we see in 2025 for financial markets.
Okay, and just kind of by way of overview for the people who are viewing this video, what we're trying to do is we're trying to put out there the topics that, as we look at investments, like what are the chief things that we need to be thinking about? And so the state of the economy was the first thing. The other thing, as you go into a year, you have to look at the state of the financial markets. So where are they? Because there are times when the economy is doing very well and the financial markets don't, and vice versa. And a lot of it has to do with things like valuation. Okay. So right now we do come into, with 2 good years behind us, we do come into a year with the price of stocks relative to their earnings above the norm. Okay, not astronomical, but higher than normal. Okay. We also have an environment in corporate America where the profit margins are very elevated, meaning that you look at a top line revenue, what trickles down to my profit, we're looking at very high profit margins. Okay. And so all in all, the state of the financial markets, are as such. Prices higher, profits good. Actually, profits could surge this year. But when you look back in time and say similar years with same environments, you wind up with, on average, modest returns. Okay. So positive returns, especially like where we are now over the next 5 years, positive returns, but average returns.
Right. One of the things that comes up over and over again as we watch financial news is, what is the Federal Reserve going to do? Because they do very much influence, maybe if not control, very much influence which direction interest rates go. So talk to us about where the Fed is and what are we looking at for their influence.
So relative to the economy, relative to the financial markets, everything in some way, shape, or form gets levered to the cost of money. And who controls the cost of money but the Federal Reserve? And so as they dictate interest rate policy, we need to keep our eye on that, because you would ask the question, are they accommodative? Are they helping the economy out? Are they restrictive? Are they trying to slow things down? And at this point in time, what has happened is they had been very restrictive through 22, early part of 23, and then started coming down. In fact, we have showed this in videos in the past. We'll pull it up and let you look at it again as I'm talking. And that is the path over the last several years that the Federal Reserve has taken. And you can see where interest rates went up. They plateaued, went sideways for a while. They are now coming down, but the latest news out from the Fed is that, hey, we're going to pause for a while, okay? Maybe not a long time, but we've got to see, do we need to be more accommodative, or will inflation come back and we've got to be a little bit more restrictive? And so we're in a sideways motion right now, which is not all bad. In fact, it helps us position things in terms of interest-bearing things at yields that are as attractive as they've been in several years.
Super. So we have covered the economy, we've talked about markets, we've talked about the Federal Reserve. And the last topic we wanted to just touch on is politics. And the reason why we want to talk about politics is because that's what you people always call us and ask about. What's going to happen? The newest administration, the new Congress, what's going to happen? And look, we know that we're talking to a broad audience. Some of you are very excited about who's in the White House right now. Others of you are devastated by who's in the White House. Our job is to serve both of you constituencies and to be realistic about both. So here's a couple of thoughts just to close out on. We tend to pay a lot of attention to politics, but what Mike and I have witnessed over the years is that politics gets the headlines in the short term, but markets get the results in the long term. Another way that we would like to say it is, in the short term, politics absolutely impacts what goes on in markets, but in the longer term, markets tend to influence the politicians a lot more than politicians influence the market. So we've looked back and we've seen various combinations of Republican and Democratic White Houses, Republican and Democratic controlled Congresses on both sides, and then various combinations of both. And when you look at all of the iterations of those things together, you still see this lower left to upper right hand trend to the long-term growth of financial markets. And so our contention is, yes, politics is important. I'm so glad that you voted if you did. But I want to tell you both, whether you're devastated or exhilarated, markets are going to impact your long-term financial future a lot more than the current occupant in the White House.
Yeah, and I'd just like to add that, it's very rewarding to see that we live in a country that has a business environment where you give us enough time once you have told us what the rules are, and we will figure out a way, to serve the American public with our businesses and make a profit doing it, and therefore serve our shareholders.
Absolutely.
And so that's it's not like that in all countries of the world.
It is not, and we are absolutely blessed to be able to speak to you from this great country of ours. So Mike and I remain very optimistic, short and long term. People ask us, okay, what should I do now, if anything? And our answer remains boring and predictable, which is stay the course.
Yeah.
Stay in the portfolio in which we have placed you after the consultations that we have had with you. And if anything changes, please call and let us know so that we can make appropriate changes in the way that we manage money for you. And so for now, what I'll simply close by saying it is such a privilege for us to serve you. We're really happy to be able to enter into this new year with you, with the opportunity to be of service to you. Call us if we can help you in any way. And until next time, he's Mike Jones. I'm Byron Moore. We serve you through Argent Advisors, and we'll talk to you soon.